Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Comfort Systems USA Inc. Annual Report. Comfort Systems USA Inc. offers a wide range of services to meet the mechanical and electrical needs of its clients. The company's services include installation, renovation, maintenance, repair, and replacement of heating, ventilation, and air conditioning systems, as well as plumbing, electrical, piping, and controls. The company operates through two main segments, mechanical and electrical. In the mechanical segment, Comfort Systems USA provides services such as off-site construction, monitoring, and fire protection. The electrical segment offers design, engineering, integration, installation, and startup of mechanical, electrical, and plumbing MEP systems in new buildings. In addition to these core services, the company also provides remote monitoring of power usage, temperature, pressure, humidity, and air flow for MEP and other building systems. This allows clients to track and manage their energy consumption and system performance remotely. Comfort Systems USA serves a diverse range of clients, including building owners and developers, general contractors, architects, consulting engineers, and property managers in the commercial, industrial, and institutional markets. With over 100 years of experience, the company has established itself as a leading provider of mechanical and electrical services in the United States. The stock price of Comfort Systems USA Inc. has skyrocketed by over 240% in the past year due to a combination of exceptional financial performance, strategic growth, and positive market indicators. The company's impressive fourth quarter and full year 2025 results, which exceeded analyst expectations, were a major contributor to this surge. With net income more than doubling to $330.8 million and revenue reaching $2.65 billion in Q4 2025, the company demonstrated its ability to execute on strong demand. The record backlog of $11.94 billion as of December 31, 2025, nearly doubling from a year prior, indicates robust future revenue potential. The company's inclusion in the S&P 500 index and increased quarterly dividend also contributed to investor confidence. Furthermore, positive analyst coverage and upgrades, driven by the company's strong operational results and advantageous position in the expanding data center market, have further boosted the stock price. The strategic acquisitions made by Comfort Systems USA have also played a significant role in its growth, contributing an estimated $200 million boost in revenue. The appointment of Trent T. McKenna as President and Chief Operating Officer has been viewed as a positive development for continued strategic direction. Overall, these events collectively painted a picture of strong growth, financial stability, and positive future prospects for Comfort Systems USA Inc., leading to its significant stock price appreciation over the past year. Comfort Systems USA Inc. market capitalization of $48 billion is significantly larger than the average industry peer of roughly $5 billion. This shows that Comfort Systems USA Inc. holds a significant advantage in their industry. Comfort Systems USA Inc. trades at a higher price-to-earnings ratio of 58 times and a higher price-to-book ratio of 21.64 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by population growth, aging infrastructure, and increasing emphasis on environmental sustainability and energy efficiency. The company's ability to capitalize on these trends through strategic acquisitions, such as Feyen Zylstra and Meissner, has also contributed significantly to its revenue growth. Additionally, same-store activity in the electrical segment and backlog increases due to acquisitions and project bookings have further boosted revenue. On the other hand, revenue decline is largely attributed to economic weakness in various geographic regions, decrease in manufacturing customer-type revenue, and a significant drop in electrical segment revenue. The company's construction service projects revenue has also seen a decline over the past 2 years. Overall, the company's revenue growth and decline are closely tied to macroeconomic trends, industry shifts, and strategic business decisions. The analysis of net income and profit margins reveals mixed trends from 2024 to 2025. On one hand, net income increased significantly in various instances, with a notable rise of $719.5 million, 48.7%, to $2.2 billion in 2025 compared to 2024. This growth can be attributed to higher interest income due to increased average cash balances and effective tax rate decreases. However, there are also instances where net income decreased or remained stagnant. For example, net income decreased by $500,125 from 2024 to 2025 on page 52. Additionally, profit margins showed varying trends across different segments. The mechanical segment's profit margins decreased from 78.7% in 2024 to 73.3% in 2025, while the electrical segment's profit margins increased from 21.3% in 2024 to 26.7% in 2025. The reasons for these changes are multifaceted and varied across different pages. Increased revenues, improved execution in operations, higher volumes at certain locations, and improvements in project execution were cited as contributing factors on several occasions. The effective tax rate decrease was also a significant factor, particularly due to the $30.5 million R&D tax credit in 2025. Overall, the analysis highlights the complexity of financial performance and the need for a nuanced understanding of the underlying drivers of change. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided summary and supporting documentation, it is explicitly stated that the company generates positive operating cash flow. This affirmation is not limited to one instance, but is consistently confirmed across multiple pages of the report, including page 6, 30, 31, 36, 39, 40, 52, and 54. The repetition of this information underscores its significance and reinforces the conclusion that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the past 2 years. According to the extracted summaries, total debt increased substantially from $68,335,000 in 2024 to $145,226,000 in 2025. This increase is attributed to an amendment to the revolving credit facility, which raised the borrowing capacity from $850 million to $1.1 billion. Regarding interest expenses, there appears to be conflicting information between pages 33 and 46. However, it can be inferred that interest expense did change significantly over the past 2 years. On page 38, it is stated that total interest expense increased from $6,648,000 in 2024 to $9,000 and $9,000 in 2025. This represents a notable increase of $2,361,000, or 35.4%. The performance of different segments and regions within a company has been analyzed based on extracted summaries. The mechanical segment stood out as a top performer, with revenue increasing by $1.15 billion, 20.7%, to $6.67 billion in 2025. This growth was driven by strong market conditions and technology sector expansion at specific locations. The mechanical segment continued its upward trend, with revenue increasing by 20.6% compared to 2024. In contrast, the electrical segment struggled, with no notable regions or locations contributing to revenue growth. Furthermore, the electrical segment experienced a significant decline in revenue, decreasing by 62.2% compared to 2023. The geographic region's performance is not explicitly stated, but it is mentioned that the company's business relies heavily on construction activity levels and economic conditions in various markets. As such, economic downturns may negatively impact the company's overall performance. Management is optimistic about the company's outlook, citing industry growth driven by factors such as population expansion and increasing emphasis on sustainability and energy efficiency. The company expects to generate $700 billion in revenue annually from commercial, industrial, and institutional mechanical and electrical contracting in the United States. To capitalize on this growth, management has outlined a clear strategy focused on providing installation services for new facilities and renovation services for existing buildings. The company operates in two business segments, mechanical and electrical, and participates in establishing engineering drawings and equipment specifications for projects. Management is confident that revenue growth will continue due to strong market conditions and improved operational execution. Additionally, the company has a proven track record of generating positive free cash flow, with 27 consecutive years of achievement. The company's strong balance sheet and surety relationships are also seen as competitive advantages. In terms of risk management, the company takes a proactive approach by managing insured risks through a captive insurance company and retaining some risk while absorbing losses under individual lines. This strategy is complemented by reinsurance to provide additional risk transfer. Overall, management's outlook is positive, driven by industry growth, strategic focus, and effective risk management. The company has demonstrated its commitment to returning value to shareholders through various means. One key aspect is the payment of dividends, which has been a consistent practice, as indicated on page 26 and page 37. This indicates that the company values its shareholders and is willing to distribute a portion of its profits back to them. In addition to paying dividends, the company has also implemented a share repurchase program, which has allowed it to buy back shares from the market. Since the inception of this program, a total of 10.9 million shares have been repurchased, page 27. Furthermore, in the year ended December 31, 2025, an additional 0.4 million shares were purchased under this program, page 27. This strategic move not only reduces the number of outstanding shares, but also enhances shareholder value by increasing earnings per share. Concerns about inventory buildup and supply chain disruption are mounting. One major concern is the significant increase in orders or commitments that may impact inventory levels. Data shows a substantial backlog, with a 27.4% increase from September 30, 2025 to December 31, 2025, and a staggering 99.3% increase from December 31, 2024 to December 31, 2025. Furthermore, supply chain disruptions are also on the rise. Lead times for certain components may extend to several months during periods of peak demand, making it challenging for businesses to meet customer needs in a timely manner. Additionally, ongoing political and economic instability is causing difficulties in forecasting and planning future business activities, leading to constrained spending on services and delays in business development efforts. Interim supply chain shortages are also being reported, including delays in delivery of certain materials and equipment. These disruptions can have far-reaching consequences for businesses, from reduced productivity to lost revenue. As a result, it is essential for companies to closely monitor their inventory levels and supply chains to mitigate the risks associated with these disruptions. That concludes the financial summary for Comfort Systems USA Inc. Feel free to comment below, and I will be happy to answer them when possible.